Okay. If you ever visit us in LA, we're the only investment bank with a full bar in our reception area. So please come and visit us in LA. We've got the dreaded second to last spot, so I'm going to try to be a little provocative without being offensive. I think we feel that the craft industry, like any industry, is going to go through three basic phases of growth. An emerging stage, which really I'm not going to get into. I don't need to go through the history, but that's really all the way back to Fritz Maytag and Anchor and New Albion and Sierra and Boston and those guys. And we're clearly in the growth phase, and we ultimately will reach a maturation phase. And I think I'm going to spend most of my time on these two phases. So let's just start with where we are today. I didn't coin this. I know ABI is in the room and Miller Coors has left the room, but I think this is from Caroline Levy at CLSA. It's basically entitled, "The Empire Has Sprung a Leak." And what we really have, and you could put Pepsi and Coke at the top of this, or you could put Campbell's Soup at the top of it, and the themes would be the same. We went through a massive homogenization of brands in America. Really started after post-World War II. The Eisenhower interstate commerce highway system kind of tied the country together, and then we had the advent of television, and all that created really just an environment for brand building. But I think we're in a market now where we are seeing major brands in permanent decline. You've got 24 million barrels are migrating from the premium to the super premium category from their peak. You've got 20 million barrels that have migrated from Miller Coors and ABI alone from their peak. And let's not forget, you've got 8 million barrels that have left the beer industry entirely and have gone to wine and spirits. So our industry as a whole is actually a modest volume decline compared to wine and spirits, but we have this massive, massive share shift within the industry from premium and super premium to craft. And that creates disruption, and it also creates opportunity. So I think there's no cause and effect, but obviously the craft market is a beneficiary of this migration of volume from the larger brands. But also, in the case of Miller Coors and Crown and ABI, they're required to innovate as a result of this, and they're going to innovate from within through the things like the Rita series or FMBs, and they're going to innovate from without. They're going to buy innovation, and that's why you're seeing a lot of this activity occurring today. Just quickly, I'm going to tick through the last, I call it last decade. We've had everybody, I'm going to shift to a shipping metaphor, a boating metaphor for the rest of the talk. What's caused all this? We've had the decline of domestic beer, which I just spoke about. There's a movement towards, artisanal, local, and authentic. And, we think this continues and will be uninterrupted. And it affects beverages, it affects food. It affects almost everything you touch today. While millennials are not the only consumers of craft beer, they certainly are a significant consumer. So the millennial movement is very relevant. And millennials are promiscuous. I have kids out of college already. They're moving from the iPhone 5 to the iPhone 6 to the iPhone 7 whenever it comes out. They are promiscuous consumers, which has an effect on your ability to build brand equity. It is just much harder today to build brand equity than it was 10 years ago. Then we have the ABI InBev deal in 2008. And I think, when August Bush III was running InBev, it was a 50% share. And when the 3G Brazilian group has come in, they're very focused on their EBITDA pool. And because of that, ABI in particular has been willing to give up share gains in exchange for price increases. And while I know a consumer doesn't hold a bottle of Bud in one hand and a bottle of Lagunitas in another hand, the fact that there has been this environment of price increases for the last 8 years has given a nice umbrella effect to the beer industry as a whole. And I think we'd question how long that's going to continue. And then let's not forget that beer is a very capital-intensive business. All the craft brewers, they love their stainless steel. I'm sure you can make a funny T-shirt how you like your stainless steel more than your mother or something like that. But craft brewers love stainless steel, and it's very expensive. Bank financing has been readily available for the last 10 years, and it's very cheap. And so a lot of craft brewers haven't had to seek equity or other forms of financing. So this low interest rate environment has certainly been a helpful contributor. And then as a result, craft, it depends on how you define it, but craft has gone from a 1% share to an 11. It's probably 14 on dollars. I think our firm is of the opinion that craft will get up to at least a 30% share. So that's how we got here. So now we're in this growth phase. Let's move on. Let's talk about 2014. We also have a business that's run by J.B. Shireman and David Duffy. It's a consulting business. And we have a major effort that consults with crafts about go-to-market strategy, SKU proliferation strategy, distributor alignment strategy. So we have a pretty good window into the operating environment of crafts. It has nothing to do with our investment banking arm, but I think we believe 2014 was a major tipping point in the market. I mean, we've talked about SKU-mageddon and being over SKU'd. I think Scott talked about it today. But there is a saturation point, and we are reaching that saturation point. And there's ramifications of that. This is very, very important, and it was a central theme of today. The local competition is a major impediment to growth if you have a regional or quasi-national craft strategy. I remember when we represented Boulevard and John McDonald, Boulevard was the local beer in Omaha, Nebraska. When he went into Nebraska, there was no Nano and there was no local beer in Nebraska. Boulevard is not the local beer in Nebraska, and he couldn't enter Nebraska in the same way they didn't enter Nebraska 10 years ago. So the strength of the Nano and the local is really hindering the geographic expansion of anybody with a strategy that's, again, a large regional or national strategy. So, if you're anybody in the top 10, Lagunitas, Sam Adams, to some extent Bell's, you've planted those flags around the country, and you've got your your beachhead. But if you're a craft today and you want to expand regionally, it's just a lot harder. That shelf space isn't there, and that share of mind with the wholesaler is not there. I've spoken to this before, but we benchmark the craft industry. We've got a large database of EBITDA margins for the industry, and I would say once you get to a kind of a level of critical mass, EBITDA margins are anywhere between 25 and 35%. Those are incredibly healthy margins. One of the reasons is that craft brewers have historically not had to invest in sales and not had to invest in marketing in a traditional way. And I'm not talking about running TV commercials or print ads, but there is an increasing need to invest in building a connection with the consumer, however you choose to do it. And then craft and craft-like competition. I don't want to get into the crafty debate, but unquestionably the Miller Coors, ABI, ultimately Crown are either going to have craft products in their portfolio, or they're going to acquire crafts, and that's going to make competing even more. I see there's a monitor down here. And then the culmination of all of this, and what we've really seen from our clients in 2014, is that velocity, and I would just crank your VIP data, but velocity is getting harder and harder to maintain. Distribution is getting more expensive to gain, and most importantly, distribution is getting very difficult to hold. So we just felt that 2014 is a tipping point. And then the question becomes, okay, what's the next 2 years look like? And I am going to get to what all this means for M&A. We really view there's some headwinds. Wholesalers are demanding a lot more support from their craft brewers. Now, if you're nano and very local, this is a little less relevant. But if you're anyone from the top 10 to the top 150, wholesalers are demanding that you're in their office with a real business plan, with a real commitment, real story behind your brands, and that's going to continue. So that in turn increases the demands on the craft beer company. So they have to invest in reps, they have to put more in marketing, they have to put more in administrative infrastructure, more in systems. So there's just an increasing level of investment over the next couple of years, we believe. We don't know, but we think there'll be a more difficult environment to take price. We do think the large domestic players are not going to compromise price integrity off-premise. I mean, when you have a business that has declining share and a declining market, one of your only ways to grow is to raise price. However, we do think the on-premise could be a very competitive ground. When you sell a keg of Goose Island or whatever for $80, I forget what the number was in the Pacific Northwest, that money isn't making it to the consumer. necessarily. So, I think the large domestics have a lot more flexibility on-premise to be very predatory and very competitive. So we just think the on-premise market's going to continue to be very, very competitive. As I've said, the ability to expand geographically is going to become more difficult. And because of all of this, we do think you're ultimately going to get to margin erosion in the industry, probably across the board. So what does this all mean for M&A? We think the craft business is getting harder and harder. Again, I think if you're a nano and you're very local and very focused, I wouldn't necessarily say that. But for anybody that has, again, larger regionals or national aspirations, it's definitely getting harder and harder. The CapEx cycles, Scott spoke about this today, the CapEx cycles are getting bigger and bigger. So it's one thing to go from 20,000 barrels, and it goes in big lumps, of course. So when you go from 20,000 barrels to 40,000 barrels, that's expensive, but it's manageable. When you go from 200,000 barrels to 400,000 barrels, or 400,000 barrels to 800,000 barrels, it really causes a lot of the founders that we work with to pause. And I actually would say that the decision around some CapEx is actually one of the primary reasons we're seeing some of our clients think about M&A decisions. We're talking about 50, 80, $100 million decisions to build out your facilities. A lot of our founders are saying, I'd like to take some chips off the table before I embark on a lot more leverage to expand my facility. There are, we talk about the class of '88, but there are a lot of founders that are reaching a point in their career that they want to do something else. And many of those founders don't have children in the business. So I think you're getting to some more serious succession planning issues. And then multiples are an all-time high. They are. One thing I do want to clarify is that a lot of people ask me, well, I've got, what multiple should you put in my business? And the answer is the multiple is the result of the work that a private equity firm will do or a strategic buyer will do. They don't really think about multiples. They don't say, oh, well, your business is an 8x multiple and your business is a 15x multiple. What they really do, if you're a private equity investor, they're going to run a returns model. And if you're ABI or Miller Coors or a strategic buyer, you're going to plug it into your own system. You're going to grow the brand under your own infrastructure. You're going to have synergies on production. You're going to have synergies on sales and marketing. You're going to have synergies on hops purchases. You're going to have synergies on glass purchases, et cetera. But ultimately, that all manifests itself in a returns multiple, the output of which is a multiple. But I will say that we feel that multiples are an all-time high. The apples to apples and point is twofold. If you got 150,000 barrels in one state, New Glarus, and you have 150,000 barrels in 40 states, pick any of the San Diego guys, that has different ramifications on valuation. Another example is if you've just finished a $50 million CapEx spend, and you don't have to spend any significant CapEx for the next 5 or 6 years, or if you're staring a 50,000 expansion in the face, that has almost a dollar for dollar effect on your valuation. And finally, on the strategic side, if you're aligned with ABI, you're aligned in Miller Coors, and you're in the state of Texas, which has extremely rigid franchise laws, or if you're in the state of California where you can move for fair market value, or in your state of New York where you've got carve-outs, you could be worth 15 times EBITDA to ABI in one state if you're aligned with their wholesaler network, and you could be worth 0 if you're in another state and you have complete disalignment. So wholesaler alignment is very important to think about if you're thinking about a strategic sale. I think as Chris pointed out, I think there was a real stigma around selling to a private equity firm, Wall Street, et cetera, 2 or 3 years ago. I think that stigma's gone. I think people are looking around when you see Uinta, Southern Tier, Sweetwater, and there are more coming. It's accepted. My kids use this term FOMO. I think it's fear of missing out. But I think people are more comfortable dealing with private equity, and frankly, they're more comfortable dealing with strategics today. And then the real question is, are we in a bubble? And I thought about this, and at first I was going to be really provocative and say, yes, right here, Brewbound, I'm calling the top of the market. We're at a bubble. Go sell your stocks. But I don't think we're at the top of the bubble. But I do think we are at the peak of the market for 2 reasons. I think we're at the absolute peak in terms of operating performance for crafts. I think EBITDA margins are as high as they're going to get. I think they can only go down because there's required investment in sales and marketing. I also think you're at the peak of growth. And yes, while the long tail is going to continue to grow, and the long tail is growing both faster in dollars, faster in percentages, and bigger in dollars than the top 10. So the top 10 are losing share but growing in dollars, and the top 10 are doing just fine. But I do think this looking backwards, we're probably at the peak growth. We do think as a firm you're going to continue to see double-digit growth at least for the next 5, 6, 7 years. We think it will go unabated, at marginally declining rates. But we do think we're at this period of peak operating performance. And combined with that, we think we're at a peak period of strategic need. So, I think ABI is already, they've set a strategy, they've defined it, and they're executing against it. Miller Coors, I don't want to predict what they're going to do, but I do predict they're going to own some crafts. I think Crown at some point will own some crafts, and I think, there is a need because of the leaky bucket. So I think you have this confluence of events of peak need by strategics and peak operating performance. So I will say I think we're at the peak of the market. Okay, this is supposed to be, I'm going to shoot my graphical artist. So this is supposed to be musical chairs. And he asked me, what does a craft brewer look like? And I said, well, think about a snowboarder, maybe somebody that's like in mountain biking or outdoors. And he kind of drew this thuggy picture. So I apologize to all the craft owners out there, but the point's the same. I do believe in the next 2 years we're in a little bit of a game of musical chairs. So my first point is for those of you that are thinking about selling to a strategic buyer, that buyer set is actually a lot thinner, a lot more disciplined, and a lot more finicky than you might think. In fact, interestingly, while the strategic buyers can pay the most, they have the synergies, so they can pay more than a financial buyer, I have found them to be the most disciplined of buyers that we've dealt with. So you'll get the most out of a strategic, but don't believe a strategic is going to be irrational on valuation. We've seen a lot of companies that thought they would be a perfect fit for a strategic buyer, and for a bunch of reasons they weren't. If you have a strategic sale in mind, just don't believe that there's a line of, I think the San Miguel deal for Founders was a wonderful deal. I think the Duval deal for Boulevard was a wonderful deal. Those are, fourth generation family companies, private. They're going to hold those breweries forever, which was important to, I think, both of those sellers. But there isn't a line of 15 other, international strategics out the door, looking to buy domestic crafts. So therefore, as a result, we do think the supply of crafts looking to sell to strategic, and by the way, there's plenty of crafts that would never sell to a strategic. It'd be the last thing they'd ever want to do. But there is a subset that do want to sell to a strategic, and I think we think that the demand by the strategics will not keep up with the supply of crafts. PE demand will remain very robust, we think, for the foreseeable future. The reason private equity is interested in craft is it's a consumer business. They're growing at double digits, and you've got extremely high margins. There are very few consumer sectors where you have all three of those factors at play. So, it's natural for all these private equity guys to want to get into the business. They love the growth, they love the brands, they love the margins. The one thing I would say, it's also an extremely capital-intensive business, and a lot of these private equity guys, like to use debt. So I would just be very cautious about the level of debt you put in your company if you're doing a private equity deal. And then, I do think I think there's a bit of a race. If you're thinking of exiting, I think there's a little bit of a race to the door. I think our firm would go on record that we think over time multiples are going to go down. I don't know if it's a year from now, and I don't know if it's 5 years from now, but I do know in 5 to 10 years from now, the multiples are not going to be what they are today. And I think I would even go under the 5-year mark. So I just think there's ultimately we're going to get some multiple compression. So what are my options? I'll race through these. ESOP, great option for people. I think I only have 2 words of caution on ESOPs. They're complex, they're difficult to manage, they're hard to unwind. And the second is if you do anything north of a lot of people like to do a 30% ESOP because there's some tax advantages. They're very levered. I mean, ESOPs come with quite a lot of leverage, either a note from the founder or bank debt and mezzanine debt. And as a general matter, I think excessive leverage in the context of a consumer business that's capital intensive is a dangerous mix. So I would just be very careful if you're thinking about doing an ESOP about the leverage associated with it. You could sell a minority of your business and retain control. And we're actually seeing increasing appetite by the private equity and family office community for minority deals. And the reason is the price environment is so high right now. They don't want to own straight common equity at a very high valuation. So a lot of private equity guys will do a minority deal, they'll do a preferred stock, so they have seniority over the common, and they'll trade that off for paying a higher price. So I actually think there's quite a lot of demand if you have an interest in selling a minority of your brewer. You can also sell a majority and retain control. And that's also very popular. I mean, contrary to what you might think about private equity, they really don't want the founder or founders or the key management team to leave. In fact, they probably won't do the deal if the founders are going to the beach. And most of these guys are not sitting with management teams in their back pocket. So it's very easy to do a majority deal, and they will very much want you to stay. I think the word of caution, if you do a deal with a private equity firm or you do a majority deal, is there's another, that private equity firm is going to need an exit. And you're not going to necessarily control your exit. And so if you do a private equity deal, I think you should just have your eyes wide open that you're probably going to turn the keys over to the private equity firm in terms of exit. Now, we did a deal with Southern Tier, and I will tell you, Finn DeMink was entirely comfortable that the family office was coming in, was not going to sell the company from under him, and they had a very collegial relationship of trust, and he got very comfortable that if it was time to sell the company, we would make that decision together. But as sort of a matter of contract, you probably will give up that right if you do a majority deal. You can do a leverage recap, and all that means is you do a majority sale, but by putting some additional leverage on your company, it actually allows you to retain more of your company and take more money off the table. You can do a multi-stage deal with a strategic. I'm not going to say which strategics are interested in that type of deal and which are not, but there is a win-win structure out there where you sell part of your company, probably 51%, to a strategic. They are going to be your ultimate buyer, but then you plug yourself into their system. You take advantage of all the synergies they bring to the table, and you substantially de-risk yourself, and then you'd have some type of a formula on the back end. And then you can sell outright. I mean, that's what Tim Barrell's done. That's what Elysian's done. That's what Blue Point's done. And, you know, I mean, it's an extremely personal decision for founders. But some founders are choosing to sell 100% of their company. And then there's been some talk about the roll-ups to an IPO. And all that means is there is a group of financial sponsors that are backing very well-seasoned executives like Rich Doyle, and they basically want to amalgamate and put together a roll-up. They want to put multiple crafts under one roof, probably with a holding company that will provide value-added services, with the ultimate exit being an IPO. I'll speak to IPOs in 1 second. Maybe I don't have IPOs. Let me just speak to IPOs for 1 second. IPOs are really tempting. They're a real pain in the butt. And you really should not get enticed with going public unless you are at least $500 million, if not a $750 million company. If you go public and you're too small, you're not going to get the market cap, you're not going to get the underwriters, you're not going to get the market float, you're not going to get the research. You're going to have some 23-year-old from Wharton on quarterly conference calls asking you why you missed your gross margin by a quarter of a point. I mean, being public, and there's cost to being public. So I would just say only the very largest crafts should really be public. And I do think in the next year, I think you're going to see 1 or 2 crafts go public. I'm quite confident of that. But being public isn't for everybody, and frankly, it's not for most of you. So just be very careful if somebody's trying to woo you into, I'm going to do a platform deal or I want to take you public. It's just very, very difficult to get done. And then finally, and I'll shut up and maybe take some questions, what does the long-term future look? And so, when will the tide crest? We don't think the tide's going to lower for a while, but it will stop rising, and at what point? We do think craft will get to 30 share. It it's still a great industry. I feel like I've been a little gloom and doom up here talking about margin erosion and the business getting harder. But it's a great industry. I mean, it's a fun industry. People love it. It's got great economic profile, and it's a great industry. And I think the craft industry is going to continue to do very, very well at the expense of the larger domestic players. An important question, again, if you're not going to stay at that nano level, is, when ABI and Miller Coors and Crown and others ultimately complete their, because I do not believe that the large domestics that will buy craft, they're not going to buy 25 crafts. They're not going to go on and on and on and on and on buying crafts. They're going to buy 5 or 4 or 6 or 7, and they're going to cement their strategy, and they're going to execute against that strategy. So I do think the world as an independent craft, if you're in that middle kind of, and we talk about it, we call it the soft middle, and Scott talked about it today. If you're not in that kind of top 10, and you're not really small, we call that the soft middle. I think it's going to be very hard, potentially to compete against the crafts that are going to ultimately be in the portfolio of the larger domestics, unless you invest in those resources for reps, unless you invest in additional resources to get your story out and connect with consumers. And let's not forget that we are in a capital-intensive business. Interest rates ultimately are going to go up. And so all that stainless steel that you've been able to get incredibly favorable financing for, ultimately is going to get more expensive. But again, I'm not here to scare you into doing a deal. I think there are going to be hundreds, if not thousands, of crafts that are going to prosper as independent companies. But if you are thinking about succession planning, or you are thinking about a partial exit, I think these are the factors that you need to consider. And we think inevitably there will be consolidation. There always is. So that's it. Sorry to do that a little fast, but there were a lot of slides there. Do you have time for questions?
We have time for a couple.
Okay.
We don't have time for questions, but squeeze them in anyway.
Your questions.
Yeah. So your partner Bill Anderson at the Beer Marketers Insights Conference last month said 25 craft transactions in the next 18 months or so. I don't want you to contradict him by any means, but do you think this is something that could actually happen? What will those transactions look like? Because he didn't say sales, he didn't say acquisitions, so transactions. What will they look like?
Well, if I were making a market, I'd probably go a little under on the 25. But, that's a lot. But I think, as I said, I think you're going to see a couple IPOs. And I think actually IPOs are going to make our business more difficult, because there's a pent-up institutional demand for craft right now. If you want to buy craft, you can only buy Sam Adams. You can buy CBA, but they have a very small float. So I think the multiples that these guys go public at are going to be quite high. And so I think the private crafts are going to be saying, well, gee, they're trading at 20 times EBITDA in the public sector. Why can't I get that? So frankly, it's going to make our job more difficult, and it may make deals more expensive. I think you'll see a couple IPOs. I think you'll see a handful of strategic deals, 4, 5. You're not going to see 10. And I think you'll see at least that many private equity deals.
Right. So I know you talked a little bit about the concerns of private equity getting into the space, and I think a lot of brewers feel that way. PE has gotten a bit of a bad rap over the years. What concerns me, I think, is that we'll get calls sometimes from some of these private equity companies asking for us to connect them with somebody who knows the space. We have money, but we don't know what we're doing with it. We need somebody to tell us what to do with our money.
Right.
What sort of challenges, what sort of risks does that present when you have these folks with these funds that aren't necessarily the best, the most knowledgeable on the actual segment?
Right. So that's scary. We've had private equity firms come to us, and we want to buy a craft, and one of my first questions is, do you know what the Tide House rules are? Do you own any restaurants in your portfolio? Oh yeah, we own three restaurant chains that sell alcohol, X. So I think you have to weed out, and if you have a good banker, they should be able to do it. You do need to weed out the PE funds that just either don't understand the industry or haven't invested the time. But I will say there's a half a dozen, if not more, I think, private equity firms that bring incredibly good expertise in building consumer brands, and I think it's inevitable and I think it would be naive not to think that you're going to have private equity and other forms of new capital in this industry. It's just too big and it's growing too fast. And I think it'll make the business more competitive. I mean, these private equity guys are not investing to starve these companies. They're investing to grow these companies. If anything, they're going to increase the marketing budgets, and they're going to look at Southern Tier. I mean, they've been out hiring, lots and lots of sales reps. So I actually think, I think hopefully none of them do. Some of them will probably screw it up, but hopefully most don't, and I think it'll make the business more competitive.
Right. So one final question before we get to our last talk of the day. I know we're keeping everyone between the happy hour and the after party at Goose Island, but buyer and seller considerations, just briefly sort of go over what you advise clients on, sort of, I guess, on both sides. If you're a buyer, what are you looking for? If you're a seller, what should you pay attention to?
Well, I think I've mentioned distributor alignment is very critical if you're doing a strategic sale. I think, the buyers are going to look at your flagships. They want to make sure you don't have flagship fatigue. They're going to scrutinize very carefully, are you growing through distribution gains, or are you growing through velocity? They're going to look at your core markets. They're going to want to make they're going to want to be sure that you're strong in your core markets. Those are the main things. What I tell sellers, I'm shocked at how many crafts haven't properly filed their IP. Button up all your IP, trademark everything you can, do it soon. I would get your financials audited. I would get good tax advice. But they're looking for all the trends that you would look in any company. Good management, resonating with the consumer, good strong trends. And good velocity, basically.
Well, this is certainly some good advice. I'm sure there's plenty of questions for you, so pick his brain before he gets on a plane tonight or tomorrow.
I'm on the last flight out, and there are thunderstorms coming, so.
All right.
Well, I will have a beer with you.
Well, maybe we'll see you at Goose Island. Thanks, Townsend.
Bye.